Hi there, everybody. My name is Keegan Halb, and this is my individual research on the financial crisis of 2008. Some of the causes and a brief explanation of the financial crisis. In the 2000s, investors wanted a low-risk, high-return investment and started to invest their money in the U.S. housing market. These investments they were buying are called mortgage-backed securities, which was explained in the video as when large financial institutions securitize mortgages. Individual mortgages are bought up by the bank and put into a pool, then sold to investors as a bulk deal. At the time, house prices were skyrocketing, so even if there was a default, investors could sell their assets, such as homes, for more money than originally purchased from the bank. Eventually, banks got greedy due to how secure these transactions were in the past and how much money they could make by selling more. Banks began to lend more and more money even to individuals with bad credit, low income, and were high risk. These mortgages were called subprime mortgages. Subprime mortgages led to predatory lending practices that were created to really take advantage of the people and their financial situations. We learned that regulation was needed to stop these predatory lending practices. More regulation in finance was needed as well to look at how exactly these banks were doing business. Specific behavioral economic factors that played a role in the crisis. One of the major behavioral traits that led to the crisis was the use of historical data to gauge the price of mortgages, although subprime lending practices were brand new at the time. Although the risk continued to rise on these investments, investors trusted the ratings rather than looking at the data that was clearly piling up against these practices. Once these questionable mortgages defaulted on payments, more houses flooded the market, ultimately bursting the housing market, increasing the supply where demand had not increased. Borrowers had mortgages that were worth more than the house itself, which created a cycle of more defaults than even more houses on the with more defaults and even more houses on the market. More regulation and government interference are needed in order to stop this from ever happening again, as well as an open market that can be observed and judged by everyone. The impact of the crisis created more government regulation. The crisis forced the government to tighten up and enforce stricter regulation on the financial market. They followed up this by enacting TARP, which initially bailed out banks, but was also expanded to bail out large automakers, the AIG, and homeowners. Huge stimulus packages and tax cuts were also enacted by the government in order to get the market jump-started again. They also created the Dodd-Frank Act. The Dodd-Frank Law, or Act, was enacted by Congress in 2010. This law increased transparency and prevented banks from taking on so much risk. It reduced predatory lending, demanded the trading derivatives are traded that everyone can observe, and put mechanisms in place that made bank failure much more controllable than before. There are many arguments for and against the Dodd-Frank Act. There is no telling if the Dodd-Frank Act will continue to be effective in the future, and there are several arguments against it as well, if it will be. A couple of these positives are bigger airbags because the Dodd-Frank banks must now offset their assets with at least 5% of equity. The leverage ratio of 20-to-1 of assets to equity. They must hold 6% of their federally insured subsidiaries, which their riskier activities tend to be housed. Some of the critics of that airbags was not enough. Some warned the increases in capital requires are insufficient, and too much. Others are rather concerned that increased equity requirements will push more activities into non-bank financial institutions, such as finance companies and hedge funds that have less regulation than banks. There's also margin is a down payment deposit to absorb future trading losses. If losses should occur, there are margin requirements in many securities markets, including the stock market. Some critics of that say there's not enough. While most swaps are required to submit it at the clearinghouse, there is exemptions for swaps involving non-financial businesses, so-called end users. This means the benefits of central clearly will not affect the swap market participants, leaving a gap in the regulatory framework. Too much as well, there is some concern that the risk of contemporary default has been moved from the financial institutions to the clearinghouses. Critics point that the clearinghouses are too big to fail, and that the Federal Reserve and taxpayers could be on the hook to bail out the clearinghouse should it run into trouble. And the final one I will explain is that under the Dodd-Frank Act, whistleblowers get a greater protection and greater rewards if they come forward. But some critics about this say there's not enough whistleblowers, and prevention can be reactivity applied so that they have not led to any legal action related to the 2008 financial crisis. There also could be an argument that there's too much whistleblowers. The dramatic increase in the size rewards could lead to a false or inflated whistleblower claims, and corporations are concerned about the potential cost of associated legality of this. That is my brief explanation and my insight on this. Thank you very much for watching, and I'll see everybody in class.